Hi, JJ here with The Art of Value. Recently, investor Michael Burry admitted to feeling greedy as the stock market crashes. So who is Michael Burry? What does he mean by feeling greedy? And is the stock market actually crashing? Who is investor Michael Burry? If you don't know, I recommend watching The Big Short or watching it again if you've forgotten how the global financial crisis played out and Michael Burry's part in it. He shorted the housing market in the US. He saw it early before it happened and shorted it, took big bets and won big there. And he's now saying that we're living through a bubble and the stock market is now crashing. So what does Michael Burry mean by feeling greedy? Well, of course, he's referring to the Warren Buffett quote, one of the most famous investing quotes of all time, where Buffett said, "We simply attempt to be fearful when others are greedy and to be greedy when others are fearful." So that implies that now's a time to be greedy, and back during the peak of the market was a time to be fearful. And Burry said so at the time. In 2021, he was warning people about the crash, and now it does seem to be playing out. He seems to be right so far. On screen is a very recent tweet by Michael Burry. It was just hours ago. He said, "This was coming because it has always been this way before. How anyone over the age of 40 did not see it coming is a riddle. The answer being greed." So it's a graph. He's attached a graph of the tech bubble, the dot-com bubble, implying that if you're over 40, you do remember that well. I do remember it and how it played out. He has been saying recently that what's playing out now is similar to the dot-com bubble rather than the global financial crisis. If you like what you've seen and heard, if you've found value in it, please drop us a like for the YouTube algo. If you're watching on YouTube, thanks very much. Is the stock market actually crashing? Let's look at some graphs. So I've got the S&P 500 here. At the moment, we're about nearly 25% down from the market peak, which you'd definitely call a bear market. Some wouldn't say that's a crash just yet, but it's not looking good. Other crashes like the dot-com bubble and the global financial crisis went down more than 50%. The S&P 500 during the GFC went down more than 50%. So we're not there yet, but he's seeing it playing out like that. And of course, the NASDAQ 100 is down nearly about 34%, and that's been going down since late November 2021. But also the Russell 2000 index, which is a small cap index, which I like to look at. I do own some small cap stocks. I prefer small cap stocks because they have greater upside, but also greater volatility in times like this, you'd think. And it's down 30.7%, third to say 31%. I've got a 5-year graph of the S&P 500 here. And if we zoom out, we can see that it's been rolled back to November 2020. Of course, we know what happened in 2020. It was a bumpy year for the stock market. There was a lot of Fed stimulus and tech stocks in particular just rocketed up. So we're only back to November 2020. So if you're thinking it's a bust, I'm sure Burry's thinking this, that it will possibly get wound back even more than that. We don't know. Nobody can predict the market, but you'd think if it went back to much further than that, it wouldn't be a surprise. And also, the same with the NASDAQ, the graph here. It's back to August 2020, which is further back, but again, you could see it going back more than that. But many of the stocks that went up, like I'm thinking of ARK, ARKK, ARK Invest's flagship fund is down hugely and almost wound back to before 2020. It's really just round-tripped back to before their huge rise. So that's the situation. Is it crashing? We could say it's on the way there, but what is a crash? Is it 25%? Is it 30%? Is it 40%? Some of the biggest crashes, the last two during the GFC and the dot-com bubble, went down more than 50%. So it wouldn't be a surprise, I'm sure, to Burry if it went down as much as that. Let's look at some other tweets to see what Burry's thinking over the last few days. He does delete his tweets, but there is an archive account that screenshots his tweets and puts them up so they can be remembered. So what he said before this, and I'll show them in sequence. I showed up here in 2020 at the beginning of the pandemic to discuss COVID. I then predicted inflation on COVID's end and warned on the effects on kids of shutdowns. In 2021, I warned on the all things bubble. Don't recall calling 8 of the last 10 crashes recessions. We'll just break down that a little bit. He talked about inflation on COVID's end, so he's talking about how the Fed stimulated and the government stimulated, and that would cause inflation. He's been correct about that, and he warned of all things bubble in 2021. Famously and controversially, he warned of Tesla and ARK Invest being in the bubble, ARKK, and he shorted those. It was a bit early. He took his shorts off before it actually worked, but they did start going down a lot. And when he says, I don't recall calling 8 of the last 10 crashes, that's the kind of joke about that people say about being a broken clock. Broken clocks right twice a day, and also the fact that economists call so many recessions and very few of them actually happen, so eventually they're going to be right. But you'd have to say that he has been pretty correct. He was a bit early, but what he's saying is actually playing out. So what do you think about Michael Burry's comments so far about there being a massive bubble that's currently deflating? Let me know in comments what you think. Do you think he's exaggerating? Do you think he's a broken clock? What are your thoughts on Burry? I know he can be controversial. He says this morning there were still 218 primary stock listings in the United States with a market cap over 1 billion and EBITDA less than negative 100 million. 29 of them had market caps over 10 billion, totaling 655 billion. Saying it again, all the silliness must go. So he's saying there's a lot of stocks still overpriced in the market, and that should end, must end, he says. He never laid out what those companies were, but somebody else did. Michael Burry Stock Tracker says in a tweet related to that, since he didn't provide the list, we decided to do it ourselves. Here's the top 12 by market cap, so you can see the companies on screen if you're on video. So if for those people on audio, I'll just name a few. There's Snow, there's Uber, there's Shop, there's Calpang from Korea, there's Square, there's Rivian, there's Sea Limited, and it goes on, Lucid. And so he's saying that these companies have still got somewhere to fall. Roblox, Dash, that's DoorDash, Palantir, Snap, and the list goes on, Grab, and Unity Software at the bottom. So he's saying watch out, and there are the tickers there on the screen for those companies. And the way that they got this, they used the filters on TradingView. I haven't checked that myself, I'm just going by what they're saying, but those are the companies that they've looked up following his lead there. So to follow that up, he also said 13.48% of stocks closed above their 200-day moving average yesterday. Bottom in 2009 was 1.2%. Bottom in 2020 was 2.8%. Currently at December 2007 levels. So what he's implying there is that there's more to come. There's a lot more to come. When he says December 2007 levels, the market didn't bottom till March 2009, so well after that. The interesting thing there is that in March 2009, things were very pessimistic. The economy didn't looking great. Things were not great at all. But the market did start turning up before the economy looked okay again. Next, he says, another feeling I'm getting is mid to late 2000, which was, of course, after the dot-com bubble started bursting, but not the bottom of the market. He says, free cash flow totally on sale and ignored while former momentum stocks are coming down, but not far enough. And darling, better businesses, in quotes, still had a ways to fall. Value was about to take off for years, despite more crash on the way. So the market didn't bottom till 2002, so he felt he's getting this mid-2000 feeling where the market started crashing, but we're not there yet. But there's still some good bargains out there, basically is what he's saying, with free cash flow totally on sale. Cash flow's on sale, which means that there are some good companies with good cash flow that are becoming bargains. And former momentum stocks are coming down, but not far enough. So there's more to come. You know, there are some that have gone down 70, 80%. It is often quoted that Amazon came down more than 90%. Jeremy Grantham talks about that in one of his quotes recently, one of his interviews recently. He was saying, I think it was 93% Amazon came down after the dot-com bubble. But if you look closely at their fundamentals, and Jeff Bezos has said this, the company was going well, it was going strong. So you've got to look at the company, not the stock price. Okay, next, Burry says, the difference between now and 2000 is the passive investing bubble that inflated steadily over the last decade. All theatres are overcrowded, and the only way anyone can get out is by trampling each other. And still, the door is only so big. So he's referring to, it's often referred to as if we're in a crowded theatre and there's a fire, catches fire, then everybody tries to rush for the exit at the same time. That's referred to being like a stock bubble where everybody has to run for the exit. Everybody panics because of the fire, but not everybody can get out. And Monish Pabros talked about this before too, saying, I think he was talking about Seritage Growth Properties, saying that the seat's getting hot. The seats are hot, but everything's fine. And that was not long before we found out that he sold. So, how hot are the seats? Is there smoke? Are we running for the exits? And Burry's referring to that kind of situation there. And it's right after that he says, I admit to feeling greedy. So he thinks that it's a 2000 tech bubble situation. But immediately after that, he also says, just remember, I was feeling greedy on the long side in 2000. So what he's saying there is the market started to crash. It was March 2000 that it started. It went down, up. There were some, relief rallies, bear market rallies, but it kept going down for a long time. So he started feeling greedy, feeling that it was the right time to buy, but the market still had a long time to go down. So he's pointing out, saying to us that there could be more to come, but he's feeling greedy. So next, Burry says low price / cash flow businesses are different today versus 2000 because they will buy back stock, buy back debt at a discount, and in general manage capital structure better. So saying it's a better situation today than it was then. Makes them statistical values, math problems that more or less must work out. So saying if you look for the right businesses right now, it's probably a better situation, and mathematically it should work out. He's very mathematical. If you remember The Big Short, I mean, it's a dramatization, of course, but he was forensic in the way that he went through information about mortgages that other people didn't. So he saw it in the data. So he's very numbers based, very methodical. And so he's saying, looking through, finding the right companies now and buying them will work out well. And it's possibly a better situation than it was in 2000. A lot of those businesses back then just had business models with nothing, and they were so overvalued, and some had zero revenue even. So that's a basic roundup of some of Michael Burry's recent tweets and thoughts about what he's thinking about the current bubble and how it's currently deflating as he sees it. So if you found value in this video, please like and subscribe if you're on YouTube, and subscribe or follow if you're on another podcast platform. And I'll see you next time.